Good afternoon. Welcome. Uh, Today we have the pleasure of meeting with the winning team of the Pershing Square Challenge, Team Valvoline, made up of Jared Duda, Garrett Wallace, and Joe Ferguson. I'm joined by Fundamental Edge founder and head trainer Brett Caughran. Today we would like to do a behind the scenes look at everything that went into crafting the pitch. They recently did a full debrief on the Yet Another Value podcast, and we'd like to focus today on the behind the scenes, digging into the process, the decisions, everything that went into crafting this prize winning pitch. So, without further ado, I'd like to cede the floor to Team Valvoline to go ahead with the pitch. Take it away.
Yeah, thank you so much for having us, Andrew and Brett. Excited to be here. So we pitched Valvoline, ticker VVV, as a long with a September 2027 price target of $84 a share. And so that is roughly 95% price upside and a 22% IRR. And we think that the risk reward skews favorably at just over 3 times here. So kind of what is Valvoline? They're an operator and franchisor of vehicle service centers, primarily located in the US and Canada. And they're mainly focused on quick lube and basic maintenance services. So in 2023, they sold their global products business, and now it's kind of a pure play unit growth and comp growth type of story. And so around half of their stores are franchised and the remainder are company owned.
Sure. Jared kind of mentioned this, but Valvoline is a very different business today than the one it was for many years. Previously, it was a subsidiary of Ashland, and only recently did they, divest the products portion of their business to now being this pure play service provider for quick lubes, as a quick lube service provider, which essentially means, this is a business that is just performing extremely well, but has only recently begun to benefit from the effects of a hyper-focused management team.
And so how do you make money in this stock? The first point is that now as a pure play, the company will have the capital and focus to really take advantage of the white space in the industry as well as secular tailwinds. The second point is that we think EV risk is overstated and the terminal value underappreciated. And the last point, this business has phenomenal free cash flow generation, and we believe that's going to drive share cannibalization going forward. So altogether, we think those three dynamics should drive low 20s IRR over the next 3 years.
Turning to that first investment thesis point, we thought about the white space opportunity and whether they could grow new units or land new units. They have essentially 1,800 units today, and we think that they can reach their goal of 3,500 plus. We thought about the addressable market, which is large and highly fragmented. We also performed a lot of proprietary research to size the white space opportunity. We wrote our own code. We can go into this in more depth later on. But essentially, we leveraged that research, and assumed current peak market density to estimate a lower bound for the white space. And then on the other hand, we assumed that quick lubes just dominate the do-it-for-me oil change market to size our upper bound for the estimate. And as you can see below, both estimates just far exceed the existing number of units today. We thought also about, Valvoline's attractive unit economics. It's just a strong value proposition for both corporate and franchisee new unit development. As you can see on the left, over the past few years, even in an inflationary environment, they were able to CAGR profitability at a rate faster than sales. And then we also estimated the unit economics and a return on a single unit over a 5-year period, and it has a 23% unlevered IRR as well as a 45% levered IRR, which is just, very, very impressive. Then we also thought about the competitive advantage and whether Valvoline can seize this white space opportunity faster and more effectively than its competitors. And we thought that they could. We think that they have the building blocks of a competitive advantage. One, they're singularly focused while their competitors are distracted. Second, Valvoline has been investing heavily in its teams and technologies, which has really driven operational excellence that shows in the results. And then lastly, they have this franchisee dynamic with a lot of large, highly capitalized players that can obviously drive unit growth, and then many smaller players that can also drive unit growth as well, which is just a dynamic that the other competitors don't have.
Yeah, so kind of turning back to the top line, Valvoline has consistently posted at least high single-digit same-store sales growth even before COVID. And we believe that the underlying traffic and ticket drivers are still intact. And while there definitely was a benefit from inflation, This isn't just an inflation story. There are some structural drivers there. And so on traffic, the main secular trend that you need to care about is the DIY to the do it for me shift. And so the DIY divide that tends to be drawn on income lines. So people with higher household incomes are simply much more likely to outsource their basic car maintenance. Then based on some demographic data and survey work, we believe that the do it for me market is poised to continue capturing share from DIY and has a lot of runway to do so, given that DIY still has around 40% of like the overall oil change market. And so as millennials and Gen Z enter their higher earning years and migrate to do it for me, this should support, sustained at least low single digit traffic growth for Valvoline boxes. Then now on ticket, there's two components on the ticket and mix side. The first is non-oil change revenue and fleet services. And these are small but rapidly growing parts of the sales mix that are highly accretive to overall ticket. And the fleet business in particular is a focus of the new CEO. So serving these customers comes with around 20% higher ticket on average and drives more store throughput. You're able to use the store in off hours to kind of serve these fleet customers. And while still early innings, even just simple initiatives like building out a CRM system or just professionalizing the opportunity to better understand and capture this fragmented market are already showing positive results in 2023 and 2024. And the other ticket driver is premiumization. As more vehicles in the car park require higher priced synthetic oil. And there is a debate around whether or not the pricing benefits of this would be offset by the theoretically longer oil change interval times that come when you move from conventional to synthetic oil. But at this point, our primary research supports this nearly unanimously. Oil change frequency is thoroughly ingrained in consumer behavior, and industry volumes really haven't been affected as more vehicles in the car park shift to synthetic. Motor oil still degrades over time, and if anything, I think people are willing to get their oil changed more often to take better care of their more higher priced, more expensive vehicles. And so kind of in summary, while we do expect unit growth will drive the majority of the future system sales growth, we think that the key traffic and ticket drivers are intact and will support that continued high single digit comp growth algorithm.
So on to our second thesis point, focus on EV risk. So, the EV debate has a wide array of ever-changing opinions. Our focus going into this was about bounding our assumption set and really bounding the downside. And so you have the EIA calling for 12% penetration by 2050 and Toyota saying it'll cap out at 30 at some point in the future. We really focus on Toyota's number to be more punitive. And the important thing here looking forward is that if just assuming historical car park growth is what it's been the past decade with 30% penetration by 2050, the ICE car park at that point is only 5% below today's level. And on top of that, it's on a straight line to that point. We did an illustrative analysis of what the ICE car park looks like from today to 2050, assuming EV sales acceleration and normal scrap rates. And the ICE car park didn't really fall below today's level until the late 2030s, meaning that there's still a lot of TAM left to be had by this company. And then going on to the second point around EVs, I think we're really starting to see the EV euphoria start to rationalize as the initial cohort of EV buyers matures. Consumers are realizing what the full cost of ownership of EVs includes, just outside of just fuel savings costs. And it really is driven by the fact that the high cost and the short useful life of the batteries of EVs has a direct impact on the residual values, which is driving higher financing, higher insurance costs, and lower than expected resale values. So in this EV transition story, there's definitely an economic hurdle to clear. And on top of that, the continued proliferation of hybrids will be a great benefit to the business because the hybrid vehicles come with pretty much the same oil change servicing needs as their fully ICE counterparts. But to wrap it all together, we're not management recognizes that EVs are coming in some form or fashion, and so they're not waiting to be the last horse and buggy in town. And so over the last year or so, they've already begun piloting programs that are geared directly towards the EV market and marketed towards the EV market to help get in front of this and see how they can address that new consumer base. And then our final thesis point is focused around continued disciplined capital allocation. As we saw on the unit economics page, these boxes are highly cash generative, and it's about what you can do with that cash. And like in the hands of an honest management, it can create phenomenal returns for investors. And so we believe that this is that kind of management team. We've seen that they don't waste cash, and they've proven that in the past. And so we expect Valvoline over the next 3 to 4 years to buy back approximately 20% of the outstanding shares and drive great returns for investors.
Building off of what Garrett just said, Valvoline's commitment to returning cash to shareholders, as well as its robust economics, really position it to become another industry cannibal like AutoZone and O'Reilly, who have been able to substantially grow net income while strategically repurchasing shares to fuel share price appreciation. The precedent they set raises our level of confidence that Valvoline will be able to do the same. And then on top of that, their shift back to EPS-based incentives for their management compensation going forward just further aligns and reinforces these shareholder supportive actions.
Yeah, and so tying all of this together, into valuation, our September 2027 price target is again $84 a share, and kind of the base case algorithm, using 24 to 27 CAGRs that gets you there, is roughly 10% store growth, 7 to 8% comp growth, kind of 15 to 16% top line growth, around 27% EBITDA margins with high 20s incrementals. So we really don't imply a lot of operating leverage here. And then with the buybacks, you have kind of that mid 20s EPS growth. And this is all kind of on 70 to 80% free cash flow conversion. And so we're ahead of the street on all metrics and kind of near the high end of management's long-term stated algorithm and their long-range plan. And we arrive at our price target using a 21 times forward PE multiple on our fiscal 28 EPS estimate. And then on our capital structure assumptions, this translates to a roughly 14 times forward EV to EBITDA multiple. And so as we mentioned earlier, we do believe that the risk reward skews attractive here. It's slightly above 3 times based on this base case assumption, then assuming nearly 30% downside in our bear case.
And we didn't consider this in our scenarios, but we believe that this business offers significant optionality that a proactive investor could take advantage of. Not only could Valvoline refranchise its corporate-owned stores, but they could also relever. Both of these options would just, potentially produce a decent amount of incremental value for investors.
And the number of key risks that we identified throughout the presentation. But at this point, that concludes the pitch.
Amazing, guys. You can tell just going through the pitch from point to point, it really shows all the work that went into it. I've got a whole slate of questions. I don't know if Brett has a question before we hop into those, or I can just dive right in.
No, super interesting. Feel free to dive in, Andrew.
All right. So one question, just to kind of kick things off, is it's about idea generation, and this is a very impressive pitch. At this level of iterations, at the very beginning, how did you come up with the idea of Valvoline? Maybe what other ideas did you consider? Maybe a little on the filtering process, and if there was some kind of sniff test you did on the idea before deciding to continue.
Yeah, so I think we all kind of came with a number of ideas that we had talked about in the past or had looked at, thought were interesting. But I think what's important about idea generation for competitions, which is unique to competitions and is different in the real world, is that we had a group understanding that the best name for a competition is not always the best name for a portfolio and vice versa, because you have 10 minutes to talk to this person and pitch to them where you have no prior accrued goodwill. And so you want to pitch them something that's simple for them to understand. They're not going to have questions in the business. And then also, if you have the opportunity to play into businesses that they like and that they've invested in before, which is unique to this competition where there's kind of one main face to it. And that's kind of how you end up at Valvoline, that franchise, kind of recession-esque proof business. Like, we really thought that Bill was going to like this, but if Jared or Joe have any other comments on the idea selection aspect.
Yeah, I think I maybe started, like, I had a big spreadsheet of kind of like just forward consensus estimates for names that I found interesting that were high level themes or something where there was a lot of debate and where like doing real value added research could really kind of give you an edge. And so again, just like kind of mapping out what the initial theoretical, the upside and downside, based on just consensus estimates, and maybe finding something that I could be different. Or, I think a thing that made Valvoline attractive was because a big overhang on the stock is the EV risk. And we were able to do that work and I think arrive at a differentiator view. We'll see if we're right. But I think kind of finding those areas where there's a lot of controversy or pervasive narrative that you can kind of work against is a really fruitful hunting ground, I think.
Yeah. And I would just add anecdotally another name that we'd considered was ICLR, which is an R&D outsourcer in the healthcare industry. And I'd been researching another sector and had some confidence that the R&D cycle would pick up again in healthcare. But what came down to like excluding that name, for instance, was the fact that it's not nearly as diligenceable as, say, like a business to consumer concept or four wall quick lube oil change service provider. So that was kind of an easy pass.
And business model changes are also are always interesting too. Like this is a business that is getting better and evolving, and there's still like a lag. Like there is still an investor education component. So I think maybe a little bit lucky on finding something like that. Where it's not as well known, but yeah, just anything where there's a ton of change.
Definitely. One of the things we talk about a lot is change and chaos proving to be fertile hunting grounds for idea generation, and certainly a business that's leaner and meaner and more of a pure play is usually worth a fresh look. Maybe on the research point, I'd be remiss if I didn't give you guys a chance to talk about really the value-added research you did in terms of diligencing the population and the superior site selection at Valvoline versus peers. Maybe folding that into a larger question, kind of how did you approach the research and winnow down the key drivers? And how did you think at the outset about what research to do? And how did your research evolve as you did more of it?
Sure. Yeah. I'm happy to kick this one off, but I think that we can all speak to it a little bit. We started to think about what potentially could be the drivers of return here for Valvoline. And, it was very helpful just to start looking at the investor presentations and also looking at, the transcripts from the analyst calls and seeing what management was focused on communicating, but also, what the analysts were focused on asking about. And it seemed to really come down to revenue growth, both in terms of unit count as well as same-store sales growth. And then, of course, there were some questions, as Jared alluded to, on EV risk. But we started to do research in those areas. And for unit count specifically, we had an opportunity to do some coding. And the question became like, how many units are there across different competitors today? And how many units can you fit in the U.S., given that the car park as well as the number of quick lube providers? So I had some coding experience, had written a number of codes in R as well as Python in the past. I had done some data scraping exercises with R, specifically the RVest package. Just a little plug there if anyone else wants to do scraping exercises. I think that is like absolutely the best package to do it with in R specifically. But anyway, we pulled the location data from Valvoline's website using the code that we had written. And then we had pulled it, as well for the other concepts. And this kind of got us a good amount of data, not just like the addresses, the locations of the, each Valvoline, but also the services that were provided at each Valvoline and to the franchisee owner for the Valvoline. So the scraping exercise got us a lot of data, and just with like a few calls to like their help desk was able to get us some answers on their database essentially and interpret the data a little bit better. And so once we had pulled the location data, then we had also pulled the state vehicle registration data as well as population data at a pretty granular level from the census, and we pulled that a time series of that data. And we thought about what could we do with this data, and we thought there may be like 4 different things that we could do. One was estimating what current peak market density was in terms of car park per quick lube in each state. And then, seeing if, the other states could essentially get to that, what would our lower bound be for the white space opportunity? Then we also thought about the fortressing opportunity that Valvoline had. So how dense are Valvoline locations in certain areas, and how less dense are they in other areas? And this is where the population data came in. So we essentially laid out the Valvolines across the United States, leveraging a Google API to place them based on their address. And then we essentially mapped like the population surrounding each of those locations, drew these like 10-mile radius circles around each Valvoline. And we found this like awesome bit of insight where there's locations where there are 21 Valvolines and 1.1 million people in the same 10-mile radius. But to the same token, where there's very few Valvolines, say 2 Valvolines in a single 10-mile radius, there were 0.8 million people. And in between that kind of spectrum of density, there were areas with even more people. So this just implied that there's a ton of fortressing opportunity that Valvoline could do, which was really cool. And we also performed this analysis across the competitors, and you could just see that they're clearly not in the same sorts of areas that Valvoline is. Or they're just kind of tapped out in the areas that they've kind of landed already. Garrett's showing a screen here where you can see that kind of like population per level of density is downward sloping across Take 5 and Jiffy Lube, and that's not the case for Valvoline, which was pretty cool to see.
And I think after kind of determining that there's all this white space there and that management actually has the ability to grow units kind of in the way that they said that they could, it's kind of digging in on the franchisee and the unit economics, because there is like a reflexivity thing in some ways of like franchisees aren't going to build boxes. The company's not going to build boxes if the unit economics aren't good. And so the state of Minnesota actually publishes, franchise disclosure documents, and you get a lot more detail on what it's like to actually own one of these boxes and what the payback period is, like kind of on a 4-wall EBITDA level, like much more detailed than what you get from just a public filing. So kind of actually, after knowing that there's the white space, seeing that the unit economics are solid, like it's going to incent people to want to continue to build more boxes. They gave us a lot of confidence in what is arguably the most important part of the top line driver, which is the unit growth. And this is thankfully something that is in the companies, like they have the most control over this as opposed to just inflation or comp or pricing.
Certainly, this should serve as a great insight to anybody watching that a lot of insights are hiding in plain sight. The locations are public information, being able to draw a 10-mile circle, census, public, all information, and certain states do make the franchise disclosure documents available. So it's maybe what we might call semi-public information, which can be a great place to look when you're doing research.
Just continue. Andrew, I had a question. It seems like the valuation exercise here is kind of a tricky one, right? So on one hand, I have a business that's demonstrably a good business, right? Mid-teens, structural revenue growth, high EBITDA, free cash flow margins. You're like, damn, you look at this page, you're like, that looks pretty good. On the other hand, you have this big, scary, high-profile terminal value issue. Terminal value issues tend not to be addressed with too much nuance in the markets, and often they're pro-cyclical, i.e. when revenues decelerate, people ascribe that to the secular, not the cyclical.
Yeah.
And I crack open slide 52. I'm like, wow, this thing's trading at 27 times earnings, is trading on FY1 above Starbucks. How did you square those kind of two dimensions of fantastic, fast-growing business with, potential, secular terminal value issues? How much of that do you think is really baked into the stock at this price?
I know Garrett can talk about the terminal value issues after, but just high level on valuation, this was something that we debated extensively internally. Valuation is always that more art than a science to some extent, but just thinking about, I think it's important to first level set. Like, we don't have a history like what Valvoline in its current form, what it's traded at on a rel-val basis through past cycles. Like, we don't have a sense for that because the business in its current form has only been around since 2023. So, and then it's also lumped in with auto retailers and, Driven Brands, which has a car wash business and an auto training school, like a lot of other stuff. Like, there really aren't any good pure play comps for what Valvoline does, but there are like business model similarities. So I think any franchise concept. So you have quick service restaurants, you have a QSR or a McDonald's, or you have Planet Fitness, which franchises gyms, Snap-on, which is like an industrial tool business, but has a franchising component in there as well. And Starbucks, while it's mostly company-owned stores, Valvoline does have a higher mix of company-owned stores compared to the purely franchise guys. So, and then Hilton, hotels. So we just tried to think about business model similarities and then compare the algorithm that we're underwriting, and that it's like the very low end of the, even what consensus is or what management's underwriting, and just the algorithm that you're getting and that you're paying for Valvoline the valuation, seems very, very reasonable. Whenever you think about it through that lens, and you're not just comparing it to O'Reilly or AutoZone or those guys. So I think like that was one thing. But then relative valuation, there's always a lot of moving parts there, and we tried to attach some fundamental free cash flow view to this. And then even if you assume that unlevered free cash flows are just going to grow with inflation, and assuming their current cost of capital, you're able to back into an implied forward EV to EBITDA multiple closer to 15 and a half times. So when you think about it through that way, the valuation, we're not as concerned about that, if that makes sense. So it's not just taking the status quo or kind of what the market thinks this thing should be valued at, just trying to think more broadly about it.
And then on the terminal value point, yeah, how we kind of look at the terminal value here is that the EV sentiment is the bear who's called 10 of the last 3 recessions, and at some point he's going to be right, but in the meantime, who's going to make the money? And so we're taking with the 3-year outlook on the valuation currently trades 25 times forward. Basically, we're calling for 21 times forward. So we're not hoping the market comes to realize that EVs are farther out than we think. We're kind of assuming there's going to be a little bit more pressure. And even at that 21 times, I think how I also looked at the terminal value was the algorithm going forward is mid 20s EPS growth for the next 5 years. Then after that, it's going to slow down. I think probably the TAM left is 16 to 20% more than they currently have, based off just their own conservative estimates. And so I just looked at it, the 12% discount rate, 7% growth for 5 more years, and then a 3-4% terminal value, and it backed right on to our exit valuation. And I think that's incredibly reasonable given the fact that in the out years, if you look at what I would call their free cash flow, like what their pre-growth cash flow is $550 million. And they're going to be buying back shares. And so, what kind of multiple do you put on that? Put it too low, and they're just going to buy you back to your eyes bleed, and put it too high, and I think put it higher, and it makes a little more sense. So, either get paid on the earnings growth through buybacks, or you get paid on the multiple up front.
Yeah. It's a great answer. Yeah, it's kind of like a distrusted growth story, right? It's like, the bear could be talking about EVs for 5 years, and every year the multiple holds, and you get 20% more. More price appreciation. The only concern is the market seems to conflate secular with cyclical. So if you get a year where Costco gives you -3 volumes, people aren't going to freak out that business is going away. They're like, mean reversion, it'll come back. The multiple will hold. But if you get a year where you see -3 volumes in this business, watch out. You probably see multiple. Multiple compression.
And the other big risk of the stock, again, was just, as management expectations. They were pretty high. Are those believable? And I think, and this is kind of where actual investing is different than pitch competitions, because this idea was a lot better in February when we were looking at it. But, I think, again, looking out that 5-year or 3 to 5 year time horizon, we're not assuming a ton of future benefit from pricing, but you saw this quarter, there are more concerns about pricing rolling over and some shorter term issues that we think, again, looking kind of having that time arbitrage lens, which I don't mean to sound intellectually lazy by saying that, but really looking past, the tougher comps, for lack of a better phrase, I think it's a better outlook. But again, it's kind of this is where the tactical stuff really gets lost at pitch competitions.
Right. Yeah. For what it's worth, I use a modified DCF that's a multi-stage where I just without knowing what this business trades at, what should it trade at. If I give it a decade of mid to low teens revenue growth and then taper 30% EBITDA margins, I get to 40 to 45 times earnings. It's kind of what it should trade at, right? Absent other factors. So
maybe
sorry to interrupt, Andrew.
No. It was those were the kinds of questions that came up during the competition. Another question that we had is a thing we like to talk about at Fundamental Edge is what we call ETIC, or everything there is to know. And this is just when you understand the business A to Z. As you were going through your research, in the interest of efficiency and knowing that the pitch competition was coming, how were you able to decide when one element of your research had hit a stopping point and it was time to move on to the next research task? Just how did you balance the need to be thorough while also being efficient?
I guess I think high level with each stock, there are typically only really 3 or 4 things that are going to move it, right? And so I think we did a good job identifying those early on and really framing our research process around those 3 to 4 things. And so there's a lot of extraneous stuff that you can get bogged down on, but I think it's fair to say we spent most of our time on those 3 to 4 things that actually mattered, and we had a little bit more time towards the end, so we tried to tighten up things around optionality or thinking about other parts of the thesis, but just in terms of balancing like that return on time spent, because again, we're in school, we're doing in semester internships, we got a lot of things going on. It was, I think, really just consistently going back to those 3 or 4 things and framing everything around that was really kind of what was able to.
Yeah.
Yeah.
And then I also think that we had a good test for whether we needed to know more or not was when we were pitching throughout the process of like the drafts, like what were the questions we were getting? And that was kind of an implication of clearly we weren't explaining it well enough, or we needed to have better detail around that. And that helped us say, like, okay, no one asked about the unit growth story after we did all our data. Like, we don't need to go out and get more information because people are believing that story and it makes sense to them. But they don't like the EV story. And so we got to go back and find out what we can learn about EVs to tell that story a little bit better. And that was a good test. We just getting other people's questions, like what didn't make sense to them.
Makes sense. Definitely staying on top of efficiency is critical, especially when alpha is in constant decay. So well done on that front. You mentioned kind of going through several iterations. Would you be able to talk a little bit about some of the resources you used as you crafted and refined your pitch?
Resources? Well, we used you. You were very helpful in our in getting feedback on that.
Wow, that's very nice of you to say.
Are you talking just more in regard to primary research tools? I mean, it was just a lot of cold emails trying to get people on the phone. Some expert network transcripts, but those guys are typically paid, so take everything they say with a grain of salt, right? I think it was just the primary research, and then going through company filings, sell side research, the FDD documents, data scraping, all that.
Yeah, and I would underline that just like the applied security analysis class offers us a lot of resources, and Jared mentioned this, that we got to use your help as well. I mean, you were our judge, I think, on pitching not once, twice, but 3 times. So twice in the class and then once after, and that was awesome and super helpful. I think it really helped us refine our research and push us down the right path. And then there were others that were brought into the classroom that helped us do the same. And then, of course, this is the investment community is a community. So like the folks that we knew from in-semester internships were able to opine on some of our thoughts, and able to connect us with others as well to just get, well-rounded feedback across the board before we actually ended up pitching, the Pershing Square final challenge.
Yeah. I was going to say, yeah, I guess the best tool we had, I think, as far as the narrative aspect was LinkedIn, just because the reason we chose this business is because it's so researchable, and we knew we could get people on the phone, and talking to just a couple or a few private equity operators or franchise operators really helped crystallize like what you were hearing was the narrative, and confirming that that's how they think, that's what they're doing, as opposed to just maybe parroting a thought that the market had.
Amazing. Very, very well done. We know that among 3 guys, you guys have 4 internships coming this summer, all at amazing firms. Maybe, Brett, did you have any final questions before Team Valvoline drives off into the distance?
What was the hardest question you got in the pitch competition?
I think it was one that Bill Ackman asked around like franchisee dynamics.
Yeah.
Again, there's a lot that you're not gonna like. We're not super in the weeds on this. Like, I mean, Bill Ackman was obviously very involved with franchise business and turnarounds and things like that, and has a much better sense for what those more insider dynamics are between those. So, I think we have a good sense for it, but it was one that maybe we didn't expect. We didn't get any questions on the valuation side, which I thought that we would get. I thought that there'd be more issue with that, but there wasn't. I'd say for me it was the franchisee question.
Yeah, and that one, Jared, was about essentially how can a really strong large franchisee partner kind of bite you at the end of the day, where they can renegotiate the take rate. So, I mean, it was a tough one.
Not a single EV question. And in all of our practices, we did it probably, I don't know, 6-7 times. Every time it's 50% EV questions, and not a single one in the competition.
Yeah.
Interesting. Yeah, I think people probably look at the valuation like, huh, what? And then they look at the top line growth like, oh, okay. So it's a pretty special story to have that level of revenue growth. I wonder if, like, I don't know, Andrew, maybe so much of at least the hedge fund industry is sectorized now. Like, I wonder who covers if it's the oil and gas person who has no idea how to do, franchise unit economics analysis, or is it the consumer person who doesn't, historically hasn't covered Ashland and these other ideas? I wonder if you're going through like an orphan period of coverage that's leading to
a bunch of jaded chemicals analysts having to believe a growth story.
Yeah, what does SSS mean?
A trail of GICS code reclassification victims in the wake. But nature abhors a vacuum, so there can always be a fresher group of investors to take a look.
Yeah, I always liked that from an idea gen perspective. Those ideas that kind of like didn't have clear coverage. I always felt like you could have a little bit more of an edge. So cool. Awesome. Great, guys. Yeah, that was it for me. Thank you so much for spending the time. Really interesting idea. One I would keep an eye on for sure. Not that many 20% plus EPS growers out there that aren't trading at stupid valuations. So, cool. Good stuff.
Of course. Thank you for having us.
Yeah, thank you.
You very much, Team Valvoline, for joining us today. We'll be... I think if Team Valvoline is okay, we'll make available a copy of the deck as elsewhere. And if you want to reach out and learn more about getting your hands on franchise due diligence documents, or just to congratulate them on this impressive analysis, you'll probably be able to do that as well. Thank you very much for your time, everybody, and enjoy the rest of your day.